Most people are going to have to borrow money during their lifetime, and we're going to take a look at some of the more standard loan types in this lesson. So let's brainstorm first. What do you think you might need a loan for? Well, there are car loans, and you might want to do a renovation on your house and need to borrow some money for that. There's actually house loans. In other words, when you buy a house, you have to borrow money. That has a special name. It's called a mortgage. You might have some repairs that need to be done that were unforeseen, and you need to borrow some money for that. Some people borrow money for trips, and there's student loans. So these are just a couple of examples of what people might want to borrow money for. And who will lend you money? Well, the banks can lend money. That's one of their major purposes. Credit cards actually lend you money in the form of credit cards. There's payday loans. So these are some of the organizations that will lend you money, and all have their pros and cons, and we're going to be discussing a little bit about those in future lessons. So there are two types of loans, short-term and long-term. Short-term means you're going to pay your loan back quickly. And they usually have high interest rates. And the types of organizations that provide short-term loans are payday loan organizations like Money Mart, or credit card companies do it too. And we're going to be talking about credit card companies in a lesson in the next lesson, and I will be talking a little bit more about payday loans in a minute. But the difference between short-term and long-term is that long-term loans you pay back slowly, and that's relative term. For a car loan, it's typically between 3 to 5 years. For a house loan or a mortgage, it can be between 20 and 30 years to pay it back. And if you do borrow from a bank for a renovation or for a major purchase, otherwise it could also be in the 3 to 5 years. So short-term loans are generally less than a year to pay it back, and the amount that you borrow tends to be less, so it's also less than $2,000 is general rule of thumb. Long-term loans are usually more than $2,000 and longer time to pay back, but the good news is that they have lower interest rates. And typically the banks provide the long-term loans. So payday loans are worth a little bit of extra discussion because they are very high risk. High risk for anybody that uses them because the fees are large, and because generally they're used by people that have no savings. And so it's easy to get into a cycle of continuously owing money. So what's important is to understand how they work. So let's say your car has broken down and it will cost you $500 to fix the car. But you have no savings. What do you do if you have to fix the car and you have no money to do it? So you could ask a payday loan organization to lend you $500. And as long as you can prove that you have a paycheck coming in, they'll say, sure, we'll do that. But there is a fee of $75 for that. So we're going to lend you this. So we're going to give you this money, $500, and you have to pay back $575. Now, because you don't have the money to pay back right away, you write a check, and that check is post-dated. In other words, the organization or the Payday Loan Society won't be able to cash that check until you get your paycheck, which is the date on the check. So let's say that's in 2 weeks. So 2 weeks later, the Payday Loan organization is expecting you to come in and pay back your $575. If you do that, they're happy and they'll rip up the check and you've paid off your loan and you're good to go. If you don't come in and pay back your $575, then they're going to not rip this up, but they're going to use this check, and this check gives them access to your bank account. And they'll take the money out directly. So that's how that works, and the reason why it's not a good idea is because this fee here is very high. And it's really high because it's a risky operation for the payday loan. They know you don't have any savings, and it's risky whether or not they're going to get their money back or not. So that's why they have to charge these really high fees. And can you imagine that once you get your paycheck, the first thing that happens on day one is you get $575 taken off of it. Well, all of a sudden you've got very little money to last you the rest of the month. And so it's easy to get into debt because of that. So payday loans should be used very, very carefully, and it's better to plan ahead and plan and save some money so that if you've got a $500 unexpected car repair, you can just use your savings to cover the cost. So banks offer loans, and they're more on the long-term basis, as I've mentioned before, and they make sure that you have collateral. So what is collateral? Well, let's say you want to buy a car and it costs money and you don't have that money to buy the car. So you want to buy the car. You don't have the money, so you go to a bank this time. And the bank will give you money, loan you money, and to pay for the car. And you then have to repay the bank the money, the loan, plus interest. That's how the bank makes money. And as long as that happens, the bank is happy and you're happy because you have a new car. Now, what happens if you do not pay back the loan? What's the bank going to do? Well, the bank isn't just going to give up. It's going to go back and say, you know what, because you didn't pay back the loan, we are going to take your car and repossess it. So the car is not yours anymore, it's ours. And they then sell it and then use the money to pay back the loan. So that car is basically an insurance for the bank, that they make sure that they're going to get their money in some form, either by you repaying it, which is the preferred method, or by selling the actual car. The car is called the collateral. It's the insurance the bank has that they're going to get money from you in some form. So the collateral, when you have a car loan, is a car. If you buy a house, the collateral is the actual house. So that's what collateral is, and that's what banks are looking for when they provide a long-term loan. So the last thing is, just to recap, if you go to the bank and would like to borrow some money, how do they guarantee that they will get their money? So before they start lending you money, they generally check 3 things. First, they check if you have the ability to pay back the loan. So they will double check what your income is, get a statement from your employer, they will check your bank accounts, see if you have any savings, or they'll check your tax information because that tells you how much money you made last year. So they're checking to make sure you're able to pay back what you want to borrow. The other thing they do is a credit check. And they do a credit check to make sure that you have borrowed money in the past and repaid it, so that you haven't forfeited on a loan or not paid back the loan. So credit checks are done, and if you have a bad credit check, they might say, no, you're too risky, we're not going to lend you the money. And then the last thing they want for big one is collateral. And we've just spoken about collateral. That means they're looking for something that's worth a lot of money that they can repossess if you happen to not pay back your loan. So those are 3 things that they will watch for before they give you a loan, and it's a way of helping them guarantee that they will eventually get their money back.